It's 6 o'clock now. I'll just give it a couple more minutes before we start. Glenn, did you just want to start?
Sure, we can start.
Oh, okay. Thank you, everybody, for attending. Today, we will be discussing the quarterly market update for Q2 of 2025. We appreciate you joining us today. Just a little housekeeping. We are recording this webinar, so we do ask if you do have any questions, feel free to use the chat feature. And welcome. We have some disclosures. And as typical, a little bit about Anew advisors. We do work with leadership of organizations and individual members. Here's a look at our team, and today joining us, we do have Glenn. A little bit of history. Oops, went a little fast there. Who we work with both law enforcement organizations and fire service organizations. This is part of our education program. We are building financial strength through education. We focus on retirement planning and investment management, leadership and organizational success, and financial goal setting and decision making. Today, we'll be talking about a market overview, what's actually happening in the world versus some media narratives, and key opportunities and risks. And at the end of the presentation, we will have the opportunity for a Q&A. So without further ado, please welcome Glenn.
Thank you, Liz. I'm going to keep this pretty short this evening. So welcome, everyone. Thank you for zooming in on a Wednesday evening, and we'll get you back to the dinner table or the entertainment that you should be enjoying this fabulous summer months. If you've heard me speak in person, which many of you have that are on this Zoom I'm seeing in the attendance, I always have this line that the news sells fear, right? Fear and greed is what sells commercials. They're always talking about the next Armageddon. So, in the first half of 2025, it continues to persist. The headlines news is always about recession, whether it's here or coming. And I always like to share that I get to travel a lot, and I get to travel around the country and visit our clients and visit prospective clients. And every airport, every airplane, every restaurant I've been in has always been very, very busy. So this recession that's supposedly coming is not here, and I don't see it coming. Persistent inflation concerns. Inflation is down relative to the last few years, but we've seen a 28% increase in inflation over the last 4 to 5 years, and those numbers are showing up in consumers' budget on a day-to-day basis. But it's a percentage of what you buy, right? So if gas goes up 10 or 20%, or groceries go up 10 or 20%, it's a relative 10 or 20% increase in your budget, depending upon where you are on the income scale. And just you need to keep that in mind for a consumption perspective across the US. Federal Reserve missteps. Media wants to talk about the Fed is not lowering rates quick enough or soon enough. I personally think they're doing a fine job right now. I don't see any issues with where we've kept rates. We'll talk a little bit about that in the next few slides. Commercial real estate doom. I do think there is a commercial real estate concern and potential issue in this country. Coming out of COVID, we saw a lot of commercial real estate, mostly professional business office buildings empty and continue to be empty. But there's various sectors of commercial real estate. And, again, the news wants to focus on one, that being office buildings. We do hold some commercial real estate in some of our income and growth portfolios, but it's got a very different focus than just office buildings. So I think you need to just have a little bit of perspective on how wide and how deep that commercial real estate market really is. Consumer debt crisis focus on rising credit card balances and delinquency as a sign of household strain. We actually have a pretty interesting chart here that talks about the U.S. consumer and their percentage of debt relative to their income. Has it increased? Yes. Is it at alarming levels? No, it's not. Tech bubble, the overvaluation of the AI and the tech sectors. I will talk about that. And I think we cover that in a couple of slides here. There is a concern about the continued increased or heightened valuations of what we call the Mag 7, right? The Magnificent Seven stocks that have driven a lot of the return over the last several years. We'll talk about that. And then geopolitical tensions. It's always there. It's always been there. It always will be there. It's also why we have a pretty dominant focus on U.S. consumerism and U.S. holdings. When we look at our investment philosophy, I'll share with you why we do that. Again, if there's any questions, feel free to throw it in the chat box and we will get to it at the end. Go ahead, Liz. Although all those fears are out there and the narratives being pushed by the media in order to sell commercials, we also know that there's some real production and some real positive aspects that are going on, not only just in the market, but in the economy as a whole. So the market's already priced in a rate cut, if you will. So if you recall, when you hear me speak, the stock market is a 6 months forwards contract on our economy or the business that it's looking at. So what it's trying to tell you is what is the price of that particular company or where the economy is going 6 months from now. And if you look at this in the various sectors and components of the securities markets, the market is pricing in a rate cut somewhere maybe towards the end of this year. Is it going to be 3 or 4 cuts? I highly doubt it, but we probably will see one cut by the end of the year. Maybe we see more. It all depends on the Fed chair, it depends on the administration. The economy, I don't think, is going to be pushing for a rate cut. We're in a very, very good position in this country. If there is a rate cut, it's going to be because they see the need to do so. Inflation continues to hold true or continues to trend down, thereby allowing the Fed to lower interest rates. Be careful with that because once you start lowering interest rates, that puts more money into the economy. It's like adding, gas to a fire. So there is a balancing act to that, and I do think our current Fed chair has done a really good job actually coming out of COVID and going into a very different administration and a very different business pro-growth mindset that we have out there. AI-led productivity surge, you're going to see in a moment the actually operating revenues that companies are spending on infrastructure for AI and technology. Is close to 50% of operating operating revenue. So it's a massive increase in spending in there. And that will come across the tech, the chips, the semiconductors, etc. We're seeing increased domestic factories being put in place to look at rare earths and semiconductors, backed by billions of dollars of government funding. So, right, wrong, or indifferent, we are seeing domestic factories being built in this country. We should see increased in gross domestic product as a result for our country. The labor market continues to be resilient. We're seeing unemployment rates remain low, even in spite of whether it's retirements, buyouts, force outs, you name it. The labor market is a very, very low aspect of unemployment, and that's very good for our economy. It's also, more importantly, very good for consumer spending. As consumers have jobs, they spend the money, and trying to understand where they spend the money is what we do, as you know, in our investment philosophy. CapEx businesses are spending money in order to increase their revenues and expand their businesses. Manufacturing is looking stable right now, along with gross domestic product, which is an output measurement of our country. Our earnings continue to beat. If you've heard me speak, I don't typically say this in front of large audiences, but I will say this one-on-one. I think when you get all these analysts in a room and they talk about projecting what a company's going to earn over the next quarter, 1 year, 3 year, and 5 years, I kind of chuckle. No one's ever right. They always underestimate so that they look good. Revisions are always up. I put very little weight in corporate earnings going forward, and I always have. Global diversification momentum. We're seeing a resurgence a little bit in international equities. which is, I think, a good thing for the global economy, although it's very segmented. It's really in the EU and Japan that we're seeing the gains. Tariff uncertainty has been a large news, I guess, caption. It's what's caused a lot of volatility. It's what's caused the March and April correction, if you will, and we'll talk a little bit about that in a couple of slides. But for every correction, there is an opportunity that lies in that. And the tariffs are very uncertain. It's a very moving target, and I think they will continue to be so with this administration. So it's an opportunity for us to take advantage of that when we can. Next, Liz. A little bit of reality. So before COVID, back in 2019, US nominal GDP, again, that's gross domestic product. That's a measurement of all the output of goods and services in the US, stood at 21.5 trillion. Today, you look at the close of second quarter 2025, it's sitting at 29.9 trillion, or up about 4.7 per year over year. So an annualized 4.7. That's a pretty healthy growth rate for our country. Anything sub three is where the Fed starts looking at how do we get our economy up and running. Anything over three looks like we're humming along for our size economy and the number of people we have in our country. Next, Liz. Just the reason I throw this in there again for the people that are on this particular Zoom that aren't our current clients, and are looking to possibly hire us. We have three mandates. We prefer individual companies over mutual funds. I want to buy the company one time and pay zero transaction cost. I want to focus on the company's balance sheet and income statement. I want them to pay dividends or cash flow to our clients, and I want them to be selling their goods and services to baby boomers and millennials, two largest generations in our country, spending money, get in front of the consumption demand. Next. S&P 500, it's a widely watched index. It's what's reported on the news. It seems like 24/7. It used to be in the morning, and then it used to be at night, open of the S&P of the markets and close. And now I feel like no matter what you turn, where you turn, what channel you're on, radio, TV, internet, they're always flashing what the S&P 500 is doing. I don't think it's a very healthy exercise, but a lot of people watch this. The point of this chart is whether you're looking back at the 2000 tech bubble in March of 2024, or the 2007 into '08 global real estate correction, or the 2020 global pandemic, or even back in this last March or April, when you look at the correction that we had, markets trends are up. When we look at this, why is there a correction? I literally was sitting in Nashville, Tennessee in our last correction of March and April, and it was all about the tariffs and the tariffs getting ready to take effect. And it really wasn't a point from an investor perspective that I felt was due justice of the level of correction was. So I went to several clients that I knew were sitting on the sidelines with excess cash and said, it's time to put this to work. And it worked out well. That's always isn't the case. Sometimes it's not that clear. But when you start talking about something that's going to happen in the future that may or may not impact the US consumer right now, and the market corrects, there are times of opportunity to look at. Next. S&P 5 index concentration. This has been a concern. This has been a concern now going on almost 3 years. If you look on the left-hand side, this looks at the price over earnings, price of the stock divided by the earnings stream. It's a valuation that we often use in this industry of the top 10 and remaining stocks in the S&P 500. What you're seeing is the top 10 stocks of the S&P 500, 10 companies out of 500 is what's really pushing the return. So it's a very concentrated return. And you need to be careful of that because as good as that feels on the upside, it doesn't feel so good on the downside. So you feel that magnification or that volatility of 10 companies. What this is telling you is that the PE ratio, or price over earnings, currently is almost 29. The average is about 21 for the top 10 stocks. The remaining 490 companies in the S&P 500 is at 20.7 currently. It's average about 15.8. So you're seeing the major percentage of price over earnings or valuations in those top 10 companies. More importantly, on the right-hand side, of the top 10, you're looking at it makes up almost 39% of the total market capitalization of the S&P 500. So it's making up almost 39% of all the value of the 500 companies, and its earnings is about 32% of the S&P 500. So it's making up almost a third of all the earnings of the top 500 companies concentrated in just 10. It's a very concentrated return stream that we're seeing in front of us. Next, Liz. Of those 10 companies, you have what's called the Magnificent Seven. So it's all the technology, right? It's the Google, it's the Amazon, it's the Facebook or Meta, it's the Nvidia, etc. And you're seeing what that has done to the S&P 500 since 2021. So of those Magnificent Seven, it's making up about 33% of the return in 21, 56% of the return in 22, 63% of the return in 23, 55% in 24, and already 21% year to date through 25 of the actual S&P 500 return. Concentration continues to remain amongst the top 10, specifically these seven. Good, bad, or indifferent, you're going to feel the pain. On the right-hand side, in 2021, the Mag 7 made up 60% of the growth. And then in 2022, it had a negative 14% growth rate year over year. And that's what really caused a major correction in 2022 in the markets, is because those seven really pulled back significantly. Bottom right looks at the best, the median, and the worst performing stock of those Magnificent Seven. So in 2021, the best stock performed 125%, the worst performed positive 2, and the median amongst those seven performed 50%. So you're seeing the wide range of returns. And when we're doing our annual reviews with our clients and we show them every single position in their portfolio, you can see this. It shows up automatically. Some of these companies have had hundreds of percentage rates of return in the holding periods that we're looking at. 22 didn't feel good. It didn't feel good for the overall market, and it specifically didn't feel good for growth or technology stocks. Down 65% was your worst, down 27% was your best, and the average was down 44%. So you felt that pain, although recovered nicely in 23. For those clients that were coming into us at the end of 21 or in 22, they had a rough sled going on in that year, and we're pulling ourselves out of that. But it's a little bit about timing as well. Next, Liz. Great chart to put the markets in perspective. This looks at the average rate of return for the specific year, and in that year, the worst day. So what you already see year to date, we're at about a 5% rate of return across the S&P 500 year to date through the close of business in June. But we've already been down as much as 19%. Again, it's that end of March, beginning of April time period. There's panic, there's fear, there's greed. The news sells that really well. Those that act on it almost always give away the upside. Next. What's really interesting about this particular quote unquote panic or correction, it was the fastest recovery ever in the stock market. So we're sitting there February 19th, the stock market's at all-time high, and then it starts crumbling. And it crumbles all the way through April 8th, right? It's just Armageddon. Tariffs are going to happen, recession's going to happen, oil prices are going through the roof, etc. And it went down almost 19%. Then it started recovering, and it took to June 27th to recover. So 89 trading days to wipe out that 19% decline. It's the fastest recovery we've ever experienced in the history of the markets. The point of the slide is this. These market cycles are coming faster, and we need to expect them to continue becoming faster. It used to be we had some visibility into not only consumption, but recessions and interest rates. The cycles are moving fast. We're in a global economy. Information is being shared very quickly. For those clients that are using us now, we just send out an email. I think it was this morning or yesterday. We have started layering in AI or technology into our due diligence and our research for our portfolio structures to help us speed up the decision-making process by which we hire, retain, or keep a particular individual security in our portfolios. So if you're not using technology or adapting to what's coming next, you will be behind the eight ball, so to speak, as these market peaks and troughs and recoveries become quicker and quicker and quicker. Next. Value versus growth. So when you look at a company, some are older, more largely established, Maybe they don't grow as fast. They're a little bit more mature. We look at those companies to produce cash flow for our clients. For those companies that are younger or don't put as much emphasis on cash to clients in the form of dividends, we look at them to grow their revenues. So there's always this value versus growth shift, if you will, in portfolios. Traditionally speaking, when you look at the left-hand side, there's about a 30% discount on value companies relative to growth. Right now, it's at 41%. It's a trigger for us to look at and say, hey, are these value companies maybe a little oversold? Are they not being valued correctly, or is growth overvalued, right? And so we lift the hood and we look at our value companies, we look at our growth companies, we look at their balance sheets, we look at their income statements. We try to understand their position and where they are not only relative to the market, but their actual growth rate. So just a little insight to how we look at some of our holdings. Next. Interesting, where are the returns coming from? So if you look closely at the top part of this grid, you're looking at the very top row, S&P weight. So that runs all the sectors in the S&P 500. If you look at the ones that pull the most weight in terms of returns and valuations, it's financials, it's industrials, it's consumer discretionary, and it's technology and consumer services. Those are what's driving the market. And what you see in QTD or quarter to date return, that's really the second quarter, and then year to date is both quarters. What's interesting is when you look at the consumer discretionary. Year to date, the consumer discretionary sector or stocks in that sector are down about 4%. But in the second quarter alone, they were up 11.5. So it's telling you something. There was all this fear out there that the US consumer is going to go into a recession. And lo and behold, the second quarter alone had 11% rate of return. As I've gone around speaking across the country, I will tell you this, I think it's almost impossible for us to have a recession during summer months. That won't show up until probably October or November in the earnings reports because I don't think you're going to hold the US consumer in the house during summer months in the US. It's the most amount of time that people get to spend outside, the most amount of travel plans, and they're willing to spend the most amount of their discretionary income. So I expect probably in October or November that we're going to have amazing earnings because earnings look backwards at the growth of the company and they get to be revised up to 3 times. So it's kind of a game, but that's what I would expect. Next. Economic growth or GDP, again, gross domestic product is just a measurement of the output of goods and services for the US. The most important part of this chart is if you look on the right-hand side, consumers, US consumers make up 68.3% of total gross domestic product. What the US consumer does is what the US economy will do. So again, demographics and consumption are a major component of our investment philosophy. Next, Liz. I, my colleague Nick threw this in here. We kind of chuckled about this. There's all this news about tariffs. So if there's going to be news about tariffs, we need to give a little bit of perspective on this. This chart is going back to the 1900 time period. If you look at where tariffs were on imports into the US by every country, 1900 is sitting somewhere around 27, 28%. You see this decline till you get to 1916, and then a resurgence back to the 30s and 40s. And then what it's doing is kind of just trending down, if you will, right? So the Trump administration comes in and says they're going to tariff the hell out of all imports. He talked about 30%. Then he's bringing it back down to 15% on some industries or countries. The point of this is this. Uh, if at 15 or 30 or anywhere in between, because we don't know where this is going to settle, we have been there before. Will it be an impact to the US business and consumer? Yes. But what we're already seeing by a lot of these companies is that technology spend, and that technology spend is increasing drastically. And they're preparing to make sure they continue to get efficiencies and drive down cost in their own companies to take on any new costs in the form of tariffs or anything that comes their way. So I think the aspect of being proactive with technology, you're going to see maybe a more minimal impact if these tariffs get put in place at the 30% level. Will we feel as consumers? Yeah, I'm sure we will. To what degree, nobody knows. So Just wanted to give some perspective on where tariffs have been in the US since 1900. The other hot topic is interest rates. The current administration is pushing for interest rates to come down. The Fed chair currently says, let's hold. We've had a lot of inflation. Uh, Inflation is subsiding. We need to get some more data. We need to feel comfortable that if we do lower interest rates, we don't have to turn around and increase them right away because the economy overheats. So what you're looking at is projected interest rates somewhere in the future. They're calling it long run. I think anything looking past 6 months to a year in markets and or interest rates is a waste of time. But what it's saying is the federal fund rates by the FOMC, Federal Open Market Committee, they meet several times a year. They're estimating that it will go down to somewhere, let's call it mid threes over the next year to 18 months. The market is estimating that it goes down faster. I think it's probably somewhere in between. Again, we've heard for 3 rate cuts, we've heard for one, we've been asked for 4 by the market. The long-term projection is to get to 3 by the FOMC. When they get there is anyone's guess. It'll all be data dependent. So, do I think interest rates are going to go down? Yes. By how much and when? Slowly, and we might get one cut this year, is my guess at this point, unless all hell breaks loose in Armageddon and we really slow down as economy. But again, I don't think you can hold the U.S. consumer in the house over summer months. Next. Um, this is really a balance sheet of consumer finances. So the biggest thing for me is when I look at the top right, debt payments as a percentage of disposable personal income. So where we got in trouble, like in '08, right? When you looked at the fourth quarter of '07, almost $16 out of every 100 the US consumer had to spend, they were sending it to debt payments, and it still wasn't covering it. Specifically, mortgages were out of control. Now we're at 11.3. Has it increased coming out of 2020? Yes. But you got to remember, coming out of the global pandemic, there was a lot of relief by the government in the form of payments. And there was a lot less spending because we were stuck in the house. And that really took an effect for quite some time on the economy. So has it increased? Yes. Is it an alarming rate? No. Is it something to be watched? Absolutely. So if that continues to rise and the US consumer slows down spending, that's a trigger for us to look at other sectors that are not as specific or as weighted for consumer discretionary returns. Next. I think this might be one of the last charts, but just real quickly on this, as I mentioned earlier in the presentation, the amount of money companies are spending on infrastructure for technology and AI is mind-blowing. So this looks at capital expenditures from the major AI companies, Alphabet, Amazon, Meta, and Microsoft. So when you look at just those 4 companies, when you follow that percentage of operating cash flow, they're spending almost 50% of their operating cash flow on AI and technology in order to increase the productivity and growth of their company. If they're doing it, everyone else will be doing it. On the right-hand side, it breaks out by sector. Who's leading the charge? Again, information technology, professional technology, education, finance, industries that are just waiting to be disrupted and really feel the optimization of technology and AI for better is food, transportation, construction, manufacturing, retail, trade, wholesale trade, admin support. They're slow to adapt technology and they're slow to adapt AI. They're going to be forced in a situation to do so over the next 5 to 10 years. You heard me earlier, we're already starting to adapt it into our core due diligence process of how we do our due diligence and our research on our portfolios. As we continue to see more opportunities to use technology, we will continue to assess the viability and the cost of doing so. If as a company you're not doing that, you're going to get left behind. Next. So that was a mouthful. Hopefully that was helpful as far as where we're sitting in the market, where the outlook is for the economy. Happy to do an annual review of your portfolio. If you decide to take us up on it sooner rather than later, feel free to reach out to us at any point. Liz, I don't know if there's any questions in the chat room or not.
Nope, but anybody can go ahead and use the Q&A at the bottom of the screen if you do have any questions.
Perfect. Thank you, everyone. If there are no questions, you know how to get a hold of us. You can reach out to us, but I really appreciate your time this evening. Thank you.